Hello and welcome to lecture 34. We are discussing the concept of opportunity cost, and in our previous lecture we have introduced this notion, right? And what was the motivation for discussing or introducing opportunity cost? Because we said that in economics, cost will always mean opportunity cost, right? The most common notion of cost is accounting cost or explicit costs. We said these are the costs for which you can assign a direct monetary value, right? Your cost of raw materials, cost of labor, cost of capital, the rent that you pay for land, your office is consuming some amount of electricity, the cost incurred for consuming those units. These are explicit costs. Now, what is not obvious is that along with these explicit costs, there is also what is known as an implicit cost. These are costs for which a direct monetary value is not immediately obvious, but it arises and is measured by the income which is foregone when the producer is using a particular resource for some production activity instead of using it for the next alternative or the next best use. So the example that we said was, suppose I am running my business from my home. So one of the rooms in my home, I am using it as office space. I am employing some amount of people. There are some machines that I have. I consume electricity. There are other raw materials that I use. All of these comprise the explicit costs. But notice, because I am using the office space, because I am using the room as office space, I am foregoing the option of actually renting out that room to somebody else who could have paid a rent for me. Now, that's an income that I have foregone, right? That I'm no longer getting. That's an implicit cost. And if I don't capture that implicit cost and if I don't factor that into account, I will be underestimating my cost of operations, right? So, opportunity cost or the total cost or the economic cost that you have in mind is the sum of the explicit cost and the implicit cost, right? So, we'll give a few definitions and then take an example. Okay. So, let me first define it. So, I will use OC to denote opportunity cost. So, opportunity cost of your choice is the value of the next best alternative that is foregone. Right? So, you have some choice that you have made. You could have used that resource for some other activity as well. So, opportunity cost of your choice is the value of the next best alternative that is foregone. And to compute opportunity cost, I essentially have to add up the explicit and the implicit costs. So, let us take an example. So, suppose you are starting a business. For this, you need to employ labor and capital. And I am just going to give numbers for easy arithmetic. So, let us say the cost is 100 for labor and the cost of capital is 80, right? This could even mean raw materials as well, capital or raw materials. So, if you add these up, rupees 180 is your explicit cost, right? So, think of this as alternative 1, right? Alternative 1 is for you to start your own business and it costs you 180 rupees in direct monetary expenses as labor expenses and raw material or capital expenses. So, that is your explicit cost. The next best alternative, which is, I will call it as alternative 2, is to work somewhere, do a job and earn a salary of rupees 75. I am just again throwing a number, right? 75,000, but I have just, let us say, normalized everything to in thousands, right? So, let us say the salary that you get is rupees 75, okay. Now, when you started a business, you are incurring some explicit costs. And notice, these are accounting costs, the direct expenses that you incur in your production activity. and your business is involved in some production activity, and that is the direct monetary expense that you have incurred, 180 rupees. But you cannot do the business as well as do a job elsewhere and earn a salary of 75. So the income that you have lost because of starting your business is rupees 75. So that's going to be your implicit cost. Right? And therefore, your opportunity cost of starting a business is the sum of the explicit and the implicit cost, which is 180 plus 75, which is rupees 255. Right? Now, if you do not factor the implicit cost into account and only include the explicit cost, then you would have underestimated your cost, right? Which means that if your total revenue from your business, so let's say you're starting your business, your total revenue is, let's say, rupees 200, right? You are producing some goods, you are selling it, and your revenue is 200 rupees, and you are claiming that this 200 rupees is greater than your explicit cost of 180. You have forgotten to include your implicit cost. You have just computed your explicit cost, which added up to 180. Your total revenue is 200, and you are claiming that this 200 rupees is greater than my explicit cost, so you are always going to be making a profit. Now, that argument is not entirely correct. All that you are doing is you have simply taken your explicit cost and your total revenue is only covering the explicit cost. But when you include the opportunity cost, your total revenue is actually less than the opportunity cost of starting the business, which is 255. This will lead to two related concepts. One is known as an accounting profit and economic profit. But at this point, I will not mention that. We will talk about it when we talk about perfect competition, right? So that's coming up in the later lectures. But essentially, the total revenue minus explicit cost is going to give me my accounting profit, right? Because explicit cost is accounting cost. So total revenue minus my explicit cost is my accounting profit. Total revenue minus explicit cost minus the implicit cost, which is essentially total revenue minus the opportunity cost, is going to give me my economic profit, right? But keep in mind that you want a condition where your total revenue is covering all the costs, and by all the costs you not only include the explicit costs, you also include the implicit costs. Okay, so at this point I will not mention about profit. I've just mentioned the revenue of 200 only covering the explicit cost for you to understand that you want to compare your revenue with the sum of the explicit and the implicit costs. Okay, so this is one way of computing the opportunity cost. Now let's also use the definition that opportunity cost of your choice is the value of the next best alternative foregone, right? Let's use this definition. Okay, is the value of the next best alternative foregone. Well, what's the value of the next best alternative? Well, the next best alternative was alternative 2, right? It was to do a job and earn a salary of rupees 75. So what's the value of the next best alternative? Well, I do the job, earn rupees 75, right? So that's money that's coming into my pocket, and then the 180 rupees that I was spending earlier still stays in my pocket. So the total amount of money in my pocket is 180 plus 75, which is rupees 255. So the value of the next best alternative is the sum of the salary that I get, right? So I'm working somewhere, because the next best alternative is to work somewhere and earn a salary of 75. So that's money coming into my pocket, and then the previous 180 rupees which was already there in my pocket continues to remain in my pocket because I no longer have to start my business. I'm not spending it on labor and other raw materials or capital. So that adds up to 180. and the total amount adds up to 255. So value of the next best alternative is 255 rupees, and that's the opportunity cost of your choice, which is alternative 1. Your choice was to take alternative 1, which is to start your business. Because of that, you had to give up your next best alternative. Suppose the next best alternative was alternative 2, which is doing a job and earning a salary of 75. So that's money coming into your pocket. And then the 180 rupees which was already there in your pocket continues to remain there. So the total amount in your pocket is 255. So the value of the next best alternative is 255 rupees, which is the opportunity cost of starting your business. And notice, when I use the definition explicit cost and implicit cost, I also got the same answer, right? So whether I use the simple formula or whether I use the notion of the value of the next best alternative foregone, I'm getting the same answer. Okay. A couple of other points relative to opportunity cost. So some observations about opportunity cost is that opportunity cost is forward looking. What do I mean by that, right? So what I mean is that opportunity cost measures the value the firm or the decision maker sacrifices at the time the decision is made, right? So it is forward looking in the sense that it is measuring the value the decision maker is sacrificing at the time the decision is made. So suppose, for example, that a firm is buying steel to produce cars, let's say, right? So you are buying steel to produce cars, and let's say yesterday I bought the steel and it cost me rupees 1 million, right? So I spent 1 million to buy steel, some amount of steel, and it costs me 1 million, right? So this is essentially the explicit cost or the accounting cost, right? Now today, so I'm using the steel, so I would have used the steel to make cars. I'm going to be selling those cars at some price. I'm going to get some revenue. But today, let's say the price of steel, the same amount of steel that I bought yesterday is, let's say, rupees 1.2 million, right? Now, because I'm using the steel to build cars, I'm foregoing the next best alternative. Well, what could have been the next best alternative? The next best alternative would be to sell the steel today and earn 1.2 million, right? So I give up the option to sell the steel at rupees 1.2 million. So rupees 1.2 million is the income foregone, which means that my opportunity cost of using steel to make cars is rupees 1.2 million and not rupees 1 million. 1 million is an explicit price, right? So yesterday the price was 1 million. Today the price is 1.2 million, right? I could have essentially sold the steel today and earned 1.2 million. So the value of the next best alternative foregone is 1.2 million. So that's the opportunity cost of your choice, which is using the steel to make cars, right? So this gives a very related, a very important idea, a related concept, which is that opportunity cost of using an input essentially is the market price, right? Because the market price for steel was 1.2 million, I could have essentially sold the steel for 1.2 million, right? and the value of the next best alternative foregone is 1.2 million. So the opportunity cost for me for my current activity of using the steel to make cars is essentially 1.2 million, right. So we can basically summarize this discussion by saying that my economic cost is essentially my opportunity cost. Right. So sometimes we will also use the word total cost, and sometimes I will drop the word economic cost and simply say cost. But whenever we are, from now on, whenever we are using the word cost, keep in mind that we always are talking about opportunity cost, right. Your accounting cost essentially is the explicit cost at historical prices, right. So your accounting cost is essentially measuring the monetary value that you incurred when you purchase that particular input. So it's the explicit cost at historical prices, and these accounting costs are typically reported in the balance sheet, right, and they are generally verifiable, right. So it needs to be verifiable, right. So the main takeaway of this discussion is that in economics, right, our notion of cost is always the opportunity cost, okay. So with this in mind, let's come to the fundamental part of this chapter, which is cost minimization. Okay. And we will look at the two input case. So as before, you have Q equals f of Lk, right, and this could be a particular functional form L times K or square root of Lk. Now I want to distinguish between two cases, and we will be very specific about each of these cases. One is what is known as the long run cost minimization problem, right. What I mean by long run is that all the inputs, in particular labor and capital, because since we are only looking at the two input case, so all inputs labor and capital are variable. If you prefer, I can change not only the amount of labor, I can also change the amount of capital. So in the long run, the firm can add more workers, and also build a new factory. If I am thinking of capital as the plant, right, and also build a new factory. Right. The other case, so we will begin with the short run, but for completeness, let's also define and specify what short run is. In the short run, one of the inputs is going to be fixed. So only some input is variable. So typically, in the labor capital input case, in the two variable input case, it is reasonable to expect that capital is the input which is going to be fixed. This is not unreasonable because it's harder to change or harder to build a new factory overnight, right? But labor can be changed, right? So labor is a changeable input. It is much more easier to change the amount of labor compared to the amount of capital. So K bar is the input which is fixed, and labor, so it's easier to change L. Right? So the distinction between long run and short run is important because cost minimization in the long run and cost minimization in the short run are going to give you two different answers, right? What do I mean by two different answers? Because what are we interested in? We are interested in identifying in the long run what combination of labor and capital should the firm use to minimize its cost. Similarly, in the short run, when capital is fixed, so the only input that I can change is labor. So what combination of labor will I now use given the amount of capital to incur the smallest possible cost? Okay. So let's begin with the long run cost minimization problem. Long run cost minimization. Okay. We'll introduce a few newer notations. So let's develop the notations. Now I am using L and K. Each unit of L is going to cost me some amount of money, right? So the per unit cost of L is going to be given by the wage rate, and let's say that's rupees per hour, rupees per labor hour, and it's going to be denoted by W. K, which is capital or machines, is also going to have some cost, per unit cost. You could think of this as the rental rate of capital, which is R, which is rupees per machine, or rupees per unit of capital, right? So think of this as the rental rate R, which is measured in rupees per unit of capital, or simply rupees per machine. Okay. Now notice, if I have used the input combination L comma K, if the input combination was, let's say, 3 comma 5, I am using 3 labor hours and 5 units of capital, then the 3 units of labor would cost me 3 times W. I will need to pay the wage rate per hour. So for 3 labor hours, I will have to pay 3 times W. The rental rate of capital is R, so for 5 machines, I need to pay 5 times R as the rental rate of capital. So 3W plus 5 times R would be the cost of this input. And notice, by cost, I mean the economic cost and the opportunity cost. So you give me an input combination labor and capital. There is a per unit price of labor. There is also a per unit price of capital. So 3 times W plus 5 times R is going to give me the cost of this input bundle L comma K. Now in general, instead of using 3 comma 5 or 4 comma 6 or 2 comma 8, suppose I had a generic bundle L comma K, that's going to cost me WL plus RK rupees. It's going to cost me this much amount of money. So what's the firm's problem? The firm's problem, the firm's objective is to minimize this cost. I'm going to denote C as WL plus RK, right? So from now on, I'm going to use the notation C to denote cost. And what am I choosing? I'm choosing the amount of labor and the amount of capital in order to minimize WL plus RK, subject to my technology allowing me to produce a certain quantity of output. So I want the firm to produce Q0 amount of output. I have some production technology. Recall, the production technology is F of LK, let's say, is equal to L times K. So I need to use that combination of labor and that combination of capital, which is allowing me to produce Q0 amount of output. But I want to produce this Q0 amount of output in the lowest possible cost way, right, or in the cost minimizing way. Now, why is this relevant? Why does this problem arise? This problem arises because it's possible to produce Q0 units using different combinations of labor and capital. Right? I can use different combinations of labor and capital to produce Q0 units. How do I know that? Because recall, you have an isoquant, which is Q0. So this is my Q0th isoquant, and the isoquant captures all combinations of labor and capital which yield the same level of output. So there are various combinations of labor and capital that I can use to produce Q0 quantity of output. So in particular, I could have input bundle A, I could also have input bundle B, and I could also have input bundle D, right? So A, B and D all lead to the same output, can produce Q0 units. But the cost associated with these bundles are going to be different. Well, what's the cost associated with bundle A? That's going to be W times LA plus R times KA. The cost associated with bundle B is going to be W times LB plus R times KB. And the cost associated with bundle D is W times LD plus R times KD. And we will very soon see that these costs are not going to be the same. They are going to be different. In fact, there are infinitely many other combinations of labor and capital which are on this isoquant, and each of them is going to cost me different amount of rupees. Right. So which of these bundles or which bundle among all these combinations is going to cost me the lowest amount of rupees? So how do we associate? So because they have different costs, how do we represent them? So how to represent the different costs? Right? So that's a question that arises. And the answer to that is that we can represent the costs by drawing what is known as ISO cost lines. And as the name suggests, ISO is same, cost. So ISO cost means same cost lines. So essentially, what are we interested in knowing? We are interested in identifying all combinations of labor and capital which are going to cost the firm the same amount of rupees. Recall, an isoquant already has combinations of labor and capital. In this graph, you can see three combinations A, B and D which are leading to Q0 amount of output, right? But these bundles may not cost the same amount. I am interested in finding all combinations of labor and capital which cost the same amount of rupees. So I want to find out, so ISO cost line describes the combinations of labor and capital that cost the same amount of rupees. For example, if my input price of labor is, let's say, rupees 10 per labor hour, and the input price of capital is, let's say, rupees 20 per machine or per unit of capital, and let's say the top management gave me a budget of rupees 1000, right? So top management told me that here is an outlay, here is 1000 rupees that is available to you. You can use this 1000 rupees, but you can't exceed that. These are the input prices of labor and capital. Now I can find out all combinations of labor and capital that are going to cost me 1000 rupees. So essentially, I can identify all combinations WL plus RK, which is essentially W is 10 times L plus 20 times K, which is going to cost me 1000 rupees, right? In fact, one combination could be that I don't use capital at all, K is 0, and I essentially use 100 units of labor. So that's a combination which is going to cost me rupees 1000. Alternatively, I use 10 units of labor, which is going to cost me 100 rupees, and then I use 45 units of capital, that's going to cost me 900 rupees, that's also going to cost me 1000 rupees. So that's a bundle that's available. Similarly, I could have 0 units of labor and essentially have 50 units of capital, that's also going to cost me 1000 rupees. So my point is, just as an isoquant is collecting all combinations of labor and capital which are going to give the firm the same level of output, an ISO cost line is collecting all combinations of labor and capital, which is going to cost the firm the same amount of rupees. So essentially, the ISO cost line can be represented as, if C bar is the cost level that I am looking at all combinations of labor and capital which are going to cost me C bar rupees. So all L and K which satisfy this condition, WL plus RK is equal to C bar, represents the C barth ISO cost line. What we will do next is that on one graph we are going to have the ISO quant, on the other graph we are going to be plotting the ISO cost lines. We will bring both of them together and we will see what the cost minimization problem of the firm yields as the answer. We will do that in our next lecture. Thank you.